We can connect.
Okay, so we're all gonna go around the room. We're gonna do a little icebreaker just so we can all learn a little more about each other. You're gonna say who you are, what do you do, and what is a New Year's Eve a New Year, a 2025 initiative you have, and that cannot be getting into shape because that's everybody.
What did you say?
Who you are, okay, who you are, what do you do, and a 2025 goal. It has that to be no long, because we have a lot of people that have a little story. I'll go first. My name is Mark Perlberg. I'm a CPA specializing in advanced tax deduction strategies. And in 2025, I'm trying to work less in the business. There we go.
My name is Prince. I'm a real estate investor, and I'm trying to use technology like AI and machine learning to optimize my real estate investment business. So,
Cool.
I'm Ty. I'm a mortgage broker, and in 2025, I'm looking to bring on at least 3 to 5 loan officers this year.
And I'm Patra. Many of you already know me. I am a tax advisor and also an investor. What I am trying to do for 2025 is to take care of my health and elevate my business
Cool.
and relationship with friends, family, and make more connections. Thank you.
Morning, afternoon. Carolina Sandin here. I'm a realtor. I started only a year ago. I was a finance director for Europe for an airline, for a cargo company. And so my plan for this year was to build up my business or continue to build up my business and connections and friends. Spend more time with my friends.
Awesome.
Yes.
Thank you, Carol.
David, I'm a technical representative for companies in the plastics industry from Turkey, Germany, France, and India. And my goal for this year is to keep staying alive.
Thank you, David.
I'm Tony Lee. I'm an entrepreneur, investor, but I'm here to learn more. Every day I want to learn something new. And the same thing I told my daughter that when she graduated from UGA as a data analyst, and I said, this is just the beginning, because in life you need to learn and learn more things to improve better. Thank you.
Rabahi, let's hear it.
Hi, my name is Ibaki. I am scheduled for this year to try different challenges, 100 calls for 100 days and, 66 posts for 66 days. So my goal is to try to have a lot of challenges this year.
Mm-hmm. Great to see you.
Yeah, good to see you, Mark.
Yeah, we gotta grab lunch sometime to talk about some of our marketing strategies.
Right,
So,
right.
He educates people on how to be, she does a lot of educational stuff on how to be an insurance adjuster, and she has like 20,000 followers on YouTube. Like,
Yeah,
you
right.
have no excuse for if you're trying to build out your channel and you think your excuse is that it's not interesting enough. I mean, that's one of the lesser sexy topics on YouTube because she's got a loyal following because she gives so much value to these people. So,
Yeah.
really
Oh, yeah,
cool.
I forgot to mention that part. But thanks for helping me, Mark.
Yeah. Ed and Zafar, so great to see you guys. Phyllis, well, I already revealed your names, but can you introduce yourself and what you do, what you're looking to achieve in 25?
All right, so my name is Edwin, and this is my wife Zipporah, and we're entrepreneurs, and we run a business. We help folks traveling to Africa to get their passport and visas. We also have a tech service company. We're looking to actually diversify our business and our investments this year into real estate. And we're so glad to be joining Patra and Mark on this journey.
By the way, Abahi, I told you there was this awesome Nigerian family that have like super fun parties. That's Edwin and Zipporah.
Oh, hey.
Yeah, because Ibahi's also Nigerian.
Yeah, I am.
Yeah.
Good.
Oh,
Good
nice.
to connect. Yeah. I'll send you my contact.
Absolutely. Love to get
We have
that.
some Nigerians here as well.
Oh, yeah, there's another
Nigerian in the house.
All right, there you go. Good to see you.
Yeah.
Support. We're
sister.
soft.
Camila.
Hey everyone, I am Camila. I'm a CPA here in Atlanta. Have my own tax practice, focusing on tax reduction strategies as well. I'm in the same group as Mark and Petra. First time here at this meeting. So good to be here. And a goal for 2025 is to eat healthier.
Awesome.
Beautiful. Dan.
How you doing, guys? I'm Daniel Gugino. I have a tax practice in Alpharetta, Georgia. I do tax prep and payroll services. We do about 100 payrolls a year. We have about 400 companies we do business taxes for, and we have about 1,400 individual clients. I'm in the 10X program where I'm about 4 weeks into it. The 10X program is a business program where you multiply your business by 10 times. So like give you an example, if you're making 100,000, they say by going through the program, you'll hopefully be at $1 million. So that I'm in the infancy of that, but that's what we're doing. That's what I'm working for. And that's my 2025 goal is to 10X my business.
Okay.
Let's go, Dan. Let's go.
Yeah,
Rick and I just did a really great podcast that we'll release on some tax credits for real estate investors, including the 45L. And believe it or not, some real estate investors think that R&D tax credits, which is pretty groovy. But Rick.
Hi, I'm Rick Claiborne, president of Sycamore Growth Group. We're a tax advisory firm specializing in credits. As Mark just said, there are two credits we focus on, the research and development tax credit and the 45L energy credit, which we just did a podcast with Mark on that. My goal is to build out my executive team, my leadership team, and during that process, we're trying to improve our systems so that we can effectively grow 35% a year every year. We've been doing that, but now our systems are starting to buckle. And so this year is to get in front of future growth by preparing our systems so that we won't hate life a year or 2 years from now when we have all this extra business, because we've been growing a lot.
I know that feeling. And we got Martin Garcia, and then Petra will introduce Mike Sullivan. You guys will talk about. Is Martin Garcia presenting?
That's my client. So, Sicilian, I know that you are at the dentist, and thank you for joining today. I would love to see you in person soon. But Sicilian, she works for Deloitte as a consultant, and I'm glad that she's here today too. And Martin, Martin, do you think that you can shout out to us a little bit, or are you free to? Martin?
All right.
That's all right.
Going once, going twice. Let's get down to business, Petra. Let's get into
Yes.
the new topic.
Yeah.
Can you
And
hear me? I'm sorry, Petra.
Hi, Martin.
Yeah, I think
Can you
I
hear
was
me?
muted. I'm sorry.
Right.
Yeah,
Would you like to
yeah.
introduce yourself a little bit?
Yeah.
With the
Yeah.
group.
Yeah, before whoever it was kicks me out, I'll be quick, I promise. We're always on billable hours here as a real estate attorney from the great state of Texas and the beautiful city of Fort Worth. Petra's been taking care of 4 of my businesses for a number of years, and my goal in 25 is to do one of these in person, since I have never seen her in person, but we always seem to get on these Zooms and work well together. So thanks for having me.
Yes, appreciate that, Martin. And hopefully either I fly to Texas or you come to Atlanta, maybe our next event about oil and gas that we are going to discuss. Thank you for joining today. And anyway,
Thank you.
yes, thank you. We have our speaker here. His name is Mike Sullivan. I club. We are partnering with Mike Sullivan. He's from Aspen Fund, and today our topic we are going to talk about private credit fund. Many of you may already heard about the word private credit fund everywhere. It seems to be very popular nowadays. But every private credit fund, it does not create equal. So that is the reason why I invited Mike to speak about it today, because with his fund that is gonna offer through our club, our well-being club, it's secured by the real estate, and I thought that is very interesting, and I'm investing into this fund myself, so I can speak a lot about it. But anyway, I'm gonna let you take it away, Mike. I'm gonna share my screen for you want
Sounds
me to
good.
share my screen, or you want to share your screen?
Why don't I do it? That way I can drive just in case we need to go back and forth. So, well, thank you for having me. Hello, everybody. Nice to be with you all today. Can you guys hear me okay?
Yeah.
Yes.
Okay, perfect. Well, kind of quick background. So I'm with, again, Aspen Funds. We're alternative investment firm based out of Kansas City, right here in the heart of the country. And as you'll see, there's snow piled up behind me, so lots of winter mix has been coming our way. So hopefully, those that are in Atlanta haven't been hit too hard, but I know it's been hitting the country. So, but yeah, my role with Aspen. So I'm the senior investor relations head, and as well as our capital development head. So in a sense, all I do is I raise the capital for us. So we're about 600 million AUM, and diversification is kind of a core tenet for us, and private credit being kind of one of those pillars for us. And so we're going to dive into the kind of fund offering that we have, and again, we're partnering here with Patra to bring this to y'all. And yeah, so I'll dive into this, and then we'll leave obviously some time for Q&A here. So I'm going to get this teed up. Make sure you guys can all see this. Do you see this okay?
It's coming. There you go. Yes.
Okay, perfect. All right, so we'll get into kind of what is the fund, what is private credit in general. As always, disclaimer: this is not an offering. So in any in any investment, of course, you need to consult the PPM. I'll kind of walk you through the specific security that's being offered. Of course, we're going to make some forward-looking statements in this presentation, but you should always consult, tax professionals on anything tax related. Fortunately, you happen to be connected with one right in front of you. So, yeah, so that's kind of standard disclaimers here. Patra, you obviously, everyone in the room seems to know you. So, I won't spend a whole lot of time on kind of the who here, but obviously Patra is partnering with us, Mark as well. These are our four partners here at Aspen. So Bob Frazier, Jim Mafuccio. These are our two founding partners. We've been operating for over 12 years, and really got started doing private credit and private debt. And that's what we've been doing for a long time, and have built a great track record doing that. Dan Schulte, Ben Frazier are the two partners that came in here about 7 years ago. So yeah, we got a great core team here. So kind of what, the Aspen difference really, I don't know why it's not really populating the process, the funnel here, but basically I can kind of tell you really what our unique approach to investment is we look at macroeconomics first. We look at macroeconomic trends. We distill those down into, what are the asset classes that are, best benefiting from those, and ultimately we kind of assemble best in class teams and business strategies to go capitalize on them. That's kind of our process from top to bottom when we look at an investment. This is a little bit of an old figure. So we're 600 million AUM, and we've got 250 million in investor capital that we manage. And this number is now 70 million, and this number is 11 plus years. So I think that was just an older figure from a couple of years ago. So yeah, so we'll get into the fund itself, just a summary of what we're doing here. So we launched this fund in April 2024. And what this is focused on is providing credit to commercial real estate properties. So this is more heavily focused on multifamily, but there's other assets in there like industrial. There might be some retail, some land development type of deals, but we're really focused on the commercial sector. And kind of the why behind that is big dislocation in the capital markets. And we'll get into kind of some of the data that surrounds that, but there's really a big need for private lending and private credit to make these deals work and have flexible terms and things of that nature. So this fund, from an investor's perspective, is focused on providing kind of a high current cash yield with still a little bit of upside through, we have a profit sharing, kind of profit splitting set up in the fund. So we'll get into some more details. So key reasons to invest, again, high current yield. So if you're looking for consistent cash flow, reliable cash flow, this is something that makes a lot of sense for investors. So we look at this in terms of kind of a pyramid. We've got a bigger allocation into more conservative, steady cash flowing type of investments. So we really like that. This particular fund, these are all preferred positions, meaning you're lower in the capital stack, so you're not taking as much risk. So we've de-risked our investments significantly. It's an open-ended structure. So this fund we've designed to be, ideally an evergreen fund, which will operate far into the future. It's a little too early to say that just yet, but it's open-ended, meaning we don't have an end date. Our kind of minimum guess is probably 10 years and, likely going to be far beyond that. But with that also comes only a 2-year lockup in the fund. So you'll be able to, if you need to, request liquidity, exit the fund and reallocate, et cetera. So that's a unique feature in an open-ended fund. We've got a strong sponsor team. So again, over 11 years of track record here in the space. Alignment and co-invest, meaning we're personally investing our own capital in LP positions on the same terms as all of our investors. So we feel that that is the correct way. And obviously, Patra's already done that herself and invested personally herself to align interests for those of you that are going to be joining her. So it's a diversified portfolio. So this fund is kind of allocating $1 to $5 million check sizes, but initially we're raising 50 million in the first year, and then we'll grow this to be multi-9-figure fund over the next couple of years. So just a couple of overviews here of kind of how we've structured the fund is we provide regular distributions. So what that looks like is we have a preferred return that gets paid every single month. And so you can rely on the kind of consistency there. We've got an initial 90-day deployment period on the front end. And so that's where we can go deploy that, take that capital in and go deploy it into new assets. But on top of that, we also have a profit share that's paid after that 3 months. So in addition to a preferred return that starts accruing after the 90 days, you're also getting an immediate pro rata share of the profits from that given quarter. So like, for example, for those that fund here in say Q1, we'll at the end of March, we'll kind of set the ownership of the fund at the given time, and we'll allocate a profit split from the profits from that quarter rata. So a lot of consistency with this, and you also have optionality to reinvest and compound the earnings. So we'll get into some more return metrics here in a little bit, but that's kind of a nice feature to this. Strategies tranches. Again, this is open-ended fund. So we calculate a quarterly net asset value, NAV. So that gets calculated every single quarter that you guys will be able to kind of account for the value of shares. The fund is kind of functionally taking preferred equity positions, issuing mezzanine loans and bridge loans to these commercial assets. So that's kind of what the fund is. That's the product, to these assets that we're issuing. And again, focused on creating current cash yield plus these profits. So investor protection, non-dilutive, meaning as we bring new cash in, that cash is used to deploy into new assets. So that way we're not diluting the returns for investors. We do have a high watermark in this fund. So it has to, what that means is before the manager can take any profit share, the NAV has to hit the highest 12-month price, basically, as you look at the trailing 12. So returns and reporting, these happen on a quarterly basis. Liquidity is a 2-year lockup and then a 90-day or what we call quarterly liquidity on the back end. That it's not a guarantee, so I'll say that it's with best effort. So we can't. We have to pay we have to have generate internal liquidity from payoffs and things like that in order to provide that liquidity to investors. But we do have a line of credit on this fund. We actually just secured it, so that'll also can be used to redeem positions from time to time. Our fund has kind of a minimum structure. So Patra, when her fund gets going, will have kind of potentially some unique minimums and things like that. But for the sake of our fund, we have a minimum investment of $100,000, and all of the returns will.
I just want to add to that, if you don't mind, Mike. If anyone who interested in investing into this fund, you can go through our club, and the minimum investment is $50,000.
Okay, got it. Yep.
Yes.
So that'll be kind of a unique benefit of Patra, is that she's securing a larger tranche that allows her flexibility to provide a lower minimum for her investors. So this is very functional with IRA investments as well. This is although we have a line of credit, it's a very small leverage ratio and very efficient because we got high yield, low leverage, and we allow for compounding, so that allows it just to continue to grow very tax efficiently. So of course, and anything we can't guarantee results, so we'll kind of caveat that. Here's the structure of our fund. So we've got 3 share classes. Kind of what what Patra is doing with us is partnering us to take one of these kind of Class B shares to kind of increase the return potential for the fund, and as a result, getting better splits, getting better preferred return, ultimately driving towards a little bit better total returns. But for our investors that are kind of in Class A, this is kind of the return structure. So we have a 6% preferred return. In addition to that 6% preferred return, we have a $70% profit split each quarter. So that's what I was kind of alluding to earlier, is that 6% gets paid monthly, and then that third month would be the last month in the quarter. So we'll close the books on the quarter and then allocate 70% of the profit on top of that preferred return. So the last 2 quarters have been double digits. I mean, we're averaging 10.5% cash yield right now. So you got a few different metrics. So you have a target net total return, and then you have a target net cash yield. So net total return is, and we'll look at this with some of the underlying assets, but the nature of these loans and positions is that you have current interest that's being paid like a mortgage, and then you also have interest that's being accrued. And so we're booking an accounts receivable, we're creating an asset, so we're creating a return. It just hasn't been realized in cash. So that's kind of the key difference between total return and net cash yield. So of that 10 to 12%, we expect 8 to 11% of that we can distribute on a regular basis. So this is kind of the range that you could expect through Patra's fund, is this same kind of range that you'd see in our fund. These again are all net of fees, so the only thing it wouldn't be net of is tax. But I did mention this fund allows for compounding. So kind of a unique feature is that you can just reinvest earnings and kind of accelerate the growth. And I'm sure Patra and Mark can kind of walk you through the power of compounding. New deal overview. This is one that we've been looking at. So this is going to give you some sense of the types of assets we're looking at. We'll here in a little bit look at some actual assets that we've closed on already that are in the fund. But this is going to give you a good sense of how we structure deals, and ultimately, what is this fund doing to generate the return. So this is so again, we're located in Kansas City. This project is right in our backyard. This is a first lien bridge loan. So we're the only debt. We're the senior debt in this particular asset. So we're coming in with a 42% loan to value, LTV, for those who don't know what that means. So loan to value would be our loan compared to the value of the property. And so
that's very good.
Very good. Yeah. If you got 42%, that means from a lender's perspective is we we have a lot of equity cover if they can't satisfy their debt obligation. They can't pay on time. We've got a lot of value to cover our interest. So
Yeah, the lower is the better as a lender, right?
as a lender, the lower the better. Yeah, you don't want to get up into the 80s and beyond. So that's where you get into trouble because the value may not actually be able to get realized. So low is good. So collateral as is value is $12.8 million. Oops. So all in interest rate, how this works is you have 16% interest. So 8% of that is paid current, and then 8% is accrual, meaning it again is booking and accounts receivable, and then it compounds. So because a lot of the fund compounds, we also the underlying assets, we have to keep the underlying assets compounding with that interest as well. So that 8% pretty quickly turns into, over call it a 3-year timeline, turns into more than 8%. Because of that compounding nature. And then we capture some fees. So we got some 3% fees on the front end. And so a lot of people would ask, well, why would they do that? Why would somebody pay you 16%? So a couple of reasons. One is a lot of traditional banks won't do these partial lien releases. So as this is a residential development. So these are luxury properties on a kind of a lake resort type of location. So a lot of folks in Kansas City, St. Louis, kind of all in the region, kind of flock. These are their second homes, and you got waterfront property. So why they would do this is they need the cash to develop. They've been working to entitle all this land, but the bank will not do partial lien releases for the lots. They will do one single loan, but they're going to have debt service on that loan. And as they sell off these parcels, and either get them developed or sell off the land itself, they're still going to have, they're not going to be able to get a release from the bank on that. And so they're going to still have debt service on an asset that they technically already sold. So it provides our flexibility, because we're not a bank, gives us unique flexibility to do those partial lien releases and kind of incrementally reduce the debt service as the properties get sold off. So that's kind of unique in that sense. So the thing we really like about this deal is, one, its location. It's right in our backyard. They got 138 lots, 126 are already entitled and shovel ready, meaning they already have permitting. They have, all of the zoning requirements are in there. They have everything they need from the government to say, hey, you're good to go. They've already got, builders lined up. They've got everything they need to actually start moving ground. So it's a great asset in that sense, and one that we're excited about because it can produce a significant return. And so why they would pay 16% is, one, it's over 16% over a short period of time for them when they're looking at this larger project is not all that big, and because they can incrementally reduce their debt service, it's even better than the alternative. So that's one that we really like. Other things we really like about it is they've got skin in the game. So they've got over 11 million of their own dollars in this project. They've owned it since 1998 through their family. And they've got a lot of experience in the development space and a big balance sheet to support it. So they got a personal guarantee on this. So we got everything we need, and then we can provide the flexibility to make the project successful for them. So that's kind of some of the examples of the types of assets we might be looking at right now. I won't go into this just because this is more market specific stuff, and but just some of the things that we look at and consider when we look at a marketplace. Yeah. So macro trends, we're going to kind of pivot, and I want to talk more a little bit about why private credit and why now, why it's an attractive time, like what we've identified in the macroeconomic spectrum as to what's creating this big benefit for. Why can we get 16% plus compounding right now? So a couple of things that are going on right now. Ultimately, inflationary environments have banks continuing to tighten credit, or there's kind of concern within institutional lending that interest rates are going to remain higher for longer. And as a result, they're going to really pull back on leverage ratios. This kind of gets into that a little bit, but really traditional lenders for, the last couple of years, and in particular now, have really reined in that leverage ratio. So they're only going to lend up to, maybe 65% of the property. So leverage, particularly in real estate, is a very powerful tool to create return, but also capital has become harder and harder to come by in some ways. And so, as an operator, somebody who's buying the asset, they're raising capital from their investors and or their network, they can get a loan on that, but they still need to come up with the remainder of the purchase price. And so what we find commonly is they've raised what they can raise, and then they come to the private sector to really kind of fulfill that capital need to close on an asset. So that's one of the things that's really driving that, is you have less availability of bank debt. And a couple of things driving, so lack of payoffs has been restricted. So what we've seen here is a lot of maturities and not a lot of payoffs kind of coming in here. So this is going to continue to kind of squeeze credit, commercial credit for these properties. And we foresee that being kind of far into the future, that we're going to have a nice runway here to continue to deploy capital and not have a whole lot of competition. And kind of what's unique about our fund is that we're playing in kind of this small to mid-size asset range where, private credit is nothing new. This is, this capital market has existed for a long time, but most of the players in here are, much larger institutions, and they have minimum check sizes in the $20 million range. Some of the more kind of middle market are in the $10 million range. So the minimums are significantly higher. And so you have this very underserved subset of assets that need, call it $1 to $5 million, $1 to $7 million. And there's just very little competition. And as a result, we've got a ton of deal flow and not a lot of competition. So if demand is high, supply is low, you can charge significant interest rates. And because we are not a bank, we have the flexibility to make the terms work with the deal and also capture a high return. So this is kind of what's driving a lot of that, is these payoffs happening, and banks are continuing to constrain that because they also have a lot of capital tied up in these assets that are not qualified to refi in some cases. So regulations restrict banks' appetite for lending, and banks are getting ready for new rules under the Basel III. So they have increased requirements at the bank level, which is, also kind of adding to this tightening effect on the lines of credit. Some of the other fundamentals that we really like in this sector is the underlying assets we see in just anything housing related is just a massive undersupply. So, some of the distress that we've seen in the multifamily sector are not necessarily an issue of the assets themselves. The assets in many cases are performing quite well. The challenge is that people overpaid for multifamily a couple of years ago, and now those loans are coming around. They bought on bridge debt. They're coming around, and the debt that they can refi out at is significantly higher than what their bridge loans were several years ago. And so as a result, that's creating distress. But if you look at the underlying fundamentals from a supply and demand perspective, there's a significant underinvestment in housing. And as interest rates rise, you have fewer and fewer developments starting. And so it's only going to kind of continue to constrict supply. So if we can get into assets and kind of have heavier allocations into assets that can perform, but have high consumer demand for, it's a really good way for us to mitigate risk. So that's why multifamily is kind of heavy focus for this fund. And it's a kind of an anchor allocation. So I think what you'll see, and we'll talk in a little bit more depth on some of the assets, you'll see that that's very much the case already with our allocation in this first year. Renting now is cheaper than owning. So we've seen, housing prices skyrocket around the country. Rents lag. So, I mean, there's even been a little bit of drop off nationally in rent growth. So there's a lot of things that are driving this, but ultimately we're going to continue to see strong demand for renting and fewer availability of single family homes, which is only continuing to increase demand as household formation continues to grow strong. So these household formation is new families getting started is on the rise. So a couple of things that we look at closely. We really like the Midwest. So this is where we're going to continue to see rent growth. We're obviously in the Midwest, but we're going to, generally stay away, at least on the residential side, from some of these larger boom markets that we've seen. At least in the short term, there's definitely some distress that's happening there. If you can buy right, then great, but I think we'll kind of stay away until some of that distress gets flushed out in those markets a little bit more. So fund strategy. So let's talk about the capital stack. So in any asset, you have what's called capital stack. So for those of you that are not familiar, what that looks like is risk and return, and then the order of priority in terms of payment. So similar to your personal home, you've got your senior mortgage. You likely don't maybe have a line of credit, but generally your senior mortgage is your first. Then you've got some type of secondary if you have a line of credit, and you're the common equity. In commercial assets, you kind of have some additional layers in here. So commonly what we see is, senior debt would be, say a bank loan. Sometimes you see private bridge loans. Those would always be considered senior. So they're first position. There's nobody in front of them in terms of priority. They get paid first. They're accepting a lower risk, but they get paid first. What we're also bringing to the table is mezzanine and preferred equity. So for us, we're going lower in the capital stack. So we're not coming in these assets as the common equity. We're coming in, in any three of these positions. But I think the majority, probably 75% of our allocation is going to be in these preferred equity mezzanine structures. And as a result, we can step in with kind of creative financing. We can get consistent cash flow, and we get paid, second in priority, but also ahead of all the common equity. So it means that before common equity can take anything, we have to get paid in full. So it's a great way to de-risk the fund and still get kind of higher returns. What we've seen, this is just kind of overview with some of the asset classes. So asset return expectations and kind of the uncertainty. So if you look at particular assets, you've got direct lending, private equity, you've got all these different assets, credit, et cetera. So you're seeing direct lending in particular is one that there's not as much uncertainty with and are set to kind of outperform. So these are kind of return metrics here. So we're seeing this poised to, from a risk and return perspective, outpace what we see with a lot of the other asset classes. So it's a great time to get into this space. And again, as I kind of showed, there's kind of a long runway that's ahead of us of continued tightening on the bank side. And so we think direct lending will continue to be a powerful piece of your portfolio. So how do we source deals? So we got placement agents. So these are brokers that we've kind of given criteria of what we're looking for, so they can bring those to us. So particularly they have a lot of deals that are in this kind of sub $5 million, and they're really difficult to place. So like I mentioned before, a lot of the guys out there, they don't want to, it's an inefficiency to do the underwriting and do the work to go issue $1 million loan. It's the same amount of work for $1 million as it is 20 million. And so there's some, there's very few people that are willing to take on that inefficiency and actually serve this. So we're one of those that were willing to take that on to kind of build market share in this subset of assets. So we've seen a lot of deals coming from placement agents. Their lenders will bring those to us. So other banks say, hey, I've got a great asset that we're lending on. We really want to bring in some preferred equity or a mezzanine loan, so we can bring those to us. Sometimes they may not even want the deal to begin with, and they'll just bring it to us. And we've got a big network of sponsors. So we're an operator ourselves. So, credit and lending is one piece of what we do. We also operate large real estate portfolios. So we're connected with a large group of capital raisers and operators around the country, and a lot of those turn into deals. So there's a few different ways that we can source them. So these are the types of deals, commonly that we see. So quick closing gap funding, which is, hey, I've got an asset, it's under contract, the senior fell through, something happened at the bank, and I can secure new debt, but they're not gonna be ready to close in time, and I've got $500,000 hard in this asset. So that's a quick close gap funding where we come in and we get 20% over, call it a 6 to 9 month period, sometimes maybe a year, but pretty short. And so that's always in first position. Those are bridge loans. Then you also have loan assumptions. So these are, deals where they've got some types of agency debt. So they got a Fannie or a Freddie loan that they're assuming from the seller, but it's only at, 45% loan to value. And so they need more working capital, and they want to juice up their returns for their investors. So they would bring us into bridge, bring a pref equity check or bring a mezzanine loan to get them up to 60, 65, something like that. And we'll look at some examples. And then new construction. So banks are reticent to lend generally on low LTVs for new construction. So they'll get a construction loan, but it's only at maybe 50% loan to cost or loan to value, and so they need some of that other that layering of finance to help them complete the project. So distress situations, we're probably not going to do much of these, just because in distress situations you typically have a basis problem where they're not qualified to refinance. So we're likely not to do much of this, but theoretically the fund could do this if it kind of fit the metrics of the fund. And that'd also be capital injection is much the same, where all the debt is in place, but they don't want to refinance yet for a certain reason, and they just need a capital injection. We can come in and sometimes dictate terms. So the times when we would do this is when the lender is willing to negotiate, some of their terms and make space for us, and potentially even give us priority to de-risk our position. So not very commonly that we'll see these, potentially not at all, but we put those in there that there might be a few occasions. So we're going to look at this asset. I'll kind of flip back and forth between these. This is one we closed on earlier this year. This was in the summertime. This was a sponsor team that we know them well. We've done other deals with them on the equity side. They've got full property management. They got vertically integrated team here in Kansas City. This asset is right in the path of progress. So myself and one of the other partners, we could probably punt a football right over here. This is a really nice Class A area, and this is just an older vintage, so classic value add type of play. So kind of the key things that we saw here was, they were assuming an agency loan at 2.94% fixed for the next 3 years. So there's 3 years left on the term, but they're only at a 45% loan to value, which means they needed to come up with 55% of the purchase price. So what we stepped in to do, we gave them a $1.5 million preferred equity check, and that combined with the senior brought them up to a 60% loan to value. So technically preferred equity is not a loan, but functionally we manage it much like a loan. And so what we've layered in here is what we call forced sale rights. So how we've structured it is they are required to pay us 8% paid current. We got a 2% origination fee on the front end. And if they default in any way on the payment of this, or default in any way on the performance, we can actually force the sale of the asset. So this is why what Patra was saying is having lower is better. So say in a situation of default, either in terms or payment, we had to force the sale of the asset, we could theoretically discount the property, sell it at a discount to somebody else, and still cover our interest, because we've got a 40% equity cushion in the asset. And so you could sell it at a 20% discount and still cover your interest. You could sell it at 30% discount and still cover your interest. So that's the key metric that we're looking at, is these kind of combined LTVs below 75% combined LTVs. So this is one that we'll do all day. I mean, it's a fantastic asset. They're already performing fantastic. So in 3 years, they're going to refinance the property. They're going to finish adding the value of the property. Their senior loan comes due, so they're going to have to refinance. And so when they refi us in 3 years, we'll get wiped out all the way. So in addition to the 8% and the 2% we have already been capturing along the way, this 6% accrued has been compounding monthly. So this quickly turned into, over 8% on the accrued. And then you have another fee on top of that. So I mean, the gross yield on this is going to be almost 19% over the course of these 3 years. So it's a fantastic return for the fund. So the fund generates kind of gross yield. Then we've got kind of fund expenses and fees. And so the net is that we can deliver these kind of low to mid-teen type of returns net to investors. So another example would be an industrial asset. So this is Waycross, Georgia, not too far from where you guys are at, kind of halfway between you and Jacksonville. We love this operator, is a very seasoned operator. We've been watching them for years, actually, and it's a great asset. This is a Class A industrial, and it was owner occupied. So the tenant was the owner, and they needed to relocate because their operations were expanding and they needed more space. So this was a Class A build to suit, and what the buyer came in was able to, because they needed to sell it quickly, they sold it at 30% below replacement cost, which means if you were to go build new right now, they're buying it at 30% below what that cost is. So they've got a really nice basis on this asset. And what they're doing is layering in preferred equity to increase the overall investor returns and give them a little bit more working capital and a little bit more flexible terms. So we have a combined loan to value at 75% between us and the senior. We got paid a origination fee. So this is where you get kind of flexible terms. Is we've got this current interest rate that is kind of a sliding scale, right? So the asset we saw just a few months ago was an 8% current with a 6% accrual. This is kind of the inverse, but we're increasing that back end because we've reduced, the current pay. And so we got a bigger compounding effect here on the back end, and obviously some bigger fees that are layered in here. So this is another one that turns into over 18% yield over a 2-year timeline. And basically their plan is just white box it, list it, sell it. They've actually already have offers for sale, and we closed on this asset in August, I want to say. So it's working. The strategy is really working, and we still have a 25% equity cushion, and we've layered in takeover rights and forced sale rights. So what takeover means is, say they're not performing on the asset, they were dissatisfied with how it's being managed. We can actually take over and move the manager out of the way and step in to either designate a manager, or we can take the asset over ourselves to manage and operate it. So in addition to that, we also have forced sale, which is where we would drag it to market. So as long as we got this kind of 25% cushion and greater, that's the point at which we feel good for the fund, where there's enough equity cushion where if we needed to, force the sale of an asset, that we can do so and do so quickly.
Mike, do you mind if I add something?
Yes, please.
Yes. So the way I look at it is, it is good to diversify your portfolio, right? And as you know that any transaction, when you are a lender, when there is a transaction between when you sell real estate, there is a buyer, there's a seller. The person who always make money is the bank, right? So becoming a lender or being a bank is the best person to be. That is one of the reasons why I decided to invest into this fund. And there are so many asset class out there: multifamily, self-storage, mobile home park, and all that. What you want to do is you want to diversify your portfolio. And this is the reason why I put this together, because I want you to consider this as like a part of your portfolio, right? Because you don't want to invest in just one type of asset class. And when we talk about the stock market, right, like there is a REIT and type of invested in the stock market, but stock market it's just one type of asset class, and it's factor into different things. Like it's like supply and demand, and it's not like you don't have any control into it. That's the reason why I think that alternative investment, this is like tax efficient investment. It's like important for you to consider to put into your portfolio.
Yeah, I would add on to that kind of differentiating from the stock market is that these are non-correlated returns. Obviously, the public markets have a lot of market correlation. This really doesn't have market correlation as it relates to things that are publicly traded. So once it's set, it's set. The interest is what it is, the accrued is what it is, the fees are what they are. And so once you've set the yield, as long as it performs, that's the numbers you're going to hit. And if they don't, then you take the asset over and or force the sale of it to cover your interest and still capture your fees. So kind of like what I was talking about earlier is you have a pyramid, and this is kind of what Patra was talking about is having have this bigger base of more conservative investments that are less risk, potentially more cash flow or more liquid, and then as you go up the slopes of the pyramid, that's risk and return. So you do fewer. They still have a place in people's portfolios, but you can do fewer of those as long as you have a firm base of kind of consistency. So if you look at the Warren Buffett saying is there's 2 rules in investing, right? Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So what he's really talking about is the power of compounding. And when you negatively compound, when you lose money, it takes so much more time because you're working against time. It takes so much more time to recover the losses. So, consistency over time that compounds and returns that compound is more powerful than trying to go hit a lot of home runs where you're taking bigger risks and potentially having higher losses. And so it's not that those investments don't have a place in your portfolio. It's just that you need to have a firm base of more conservative to build on. Yeah, so that was that asset. We'll talk about this one. This one's actually right in your market as well. So in Atlanta, Georgia, this is a great asset. It's called St. James Place. It's a multifamily asset. So the sponsors in Atlanta, they've got over 20 full cycle deals. They are an expert, and actually they're so good that how this happened was the lender was forced the sale because of underperformance of the previous owner, and the sponsor was handpicked by the senior lender. So the senior lender said, "Hey, you guys are the best, and I want you to come operate this asset." So the senior took the asset over, forced the old owner out, brought in a new owner, and so they bought it. They restructured it so they had kind of a reduction to the basis. And so what we did is we stepped in with a $1.7 million check. We combined the LTV up to 70%, gave them a little bit more working capital, and the rest is history. So we have takeover rights, we have for sale rights in this asset as well. This operator has already taken this and rebounded this entire property, so it's already performing very, very well. So great market. Atlanta's a great market. A lot of great underlying economic factors there, growth factors. So 2 year, we got 6% paid current. We get 10% accrued, which compounds annually. So this gave them the flexibility because they basically what happened with the property is the previous owner let the occupancy drop, I think, below 70%. And so they had their cash flow significantly restricted. They couldn't project manage. They didn't have enough cash. They couldn't cover the debt service, and they had a bunch of problems. So the fact that we were able to come in and kind of layer some more flexible terms for this huge back end, there's a huge upside. This is only a 2-year loan with a 1-year optional extension, so call it 2 to 3 years, and we're going to get a nice big kicker on the back end with our fees and the compounding. Yeah, next one's Bentonville, Arkansas. I'm going to fly through some of these because you're going to see there's a lot of similarity. This one will kind of be the last I'll focus on just because it's a development deal. So this is Bentonville, Arkansas. This is the fastest growing cities in America. So kind of the growth that we saw in Austin several years ago. This is kind of what we're seeing in this marketplace, and there is no housing. There's zero, and prices have gone through the roof. Rents have continued to grow. So as national rents have kind of slowed and in some markets kind of gone down, they've continued to hockey stick. And so tons of rent growth continuing to flood this market. And so they need more multifamily. So this is a developer that has over $9 million in equity in the deal. They have personal guarantees on this. They've got a ton of experience. I mean, this is a family-owned developer who's been in business for, I want to say, over 40 years. So they've got deep history in this market, in this region. And we've got other assets in this market that we have on the equity side that have performed very well. And we've got a great level of confidence in the market. And pretty straightforward. So we came in with a two-year loan or 2-year pref equity check. So same thing here. They got a construction loan. We stepped in with preferred equity, had some flexible terms with this kind of flexibility on the back end. But the really big thing is you get 0.5% of the sale price on the back end. So it's what we call an equity kicker, which is a really big deal for an asset like this. I mean, this is over 200 units of Class A multifamily. So this is, this is a $60 million property. And so you're going to get a really nice bump on the back end of this. And because they personally guaranteed it, and we've got a nice equity cushion here. I mean, already with the entitlements, everything they've done, they've already doubled the value of the land that they've already done. So it's one that we really like. Here's the asset. So they've already done the entitlements. They cleared the ground. It was already shovel ready, basically. But the exit valuation, to kind of put this in simple terms, is our basis on this, if we ever had to take this asset over, is $150,000 per door. So our coverage in a market that is at 233, you do the math across, over 200 units. So we've got a lot of equity cushion in here. I mean, we're looking at kind of as is valuations of loan to cost. So this is the cost to develop, but the actual valuations are significantly higher that we haven't modeled in. So we've got a lot of downside coverage if we ever had to take the asset over. So there'll be some other small assets, neighborhood retail, neighborhood strip. We've got some other, this is kind of Class B multifamily and some other tertiary markets. We'll continue to do deals like this. We've got a big pipeline full of deals. So from a performance standpoint, so again, we launched this fund in April 2024 as when we formed it, and then we started bringing capital in and deploying capital in May. So we kind of had a partial quarter in Q2. We've had 2 full quarters of Q3 and Q4, and so the average yield already, the cash yield is already 10.5 or 10.45, so just under 10.5 on the cash yield already. So that's delivered to investors. So we've been very efficient with the deployment of that. We've got a lot of capital that we just brought in here in Q4 and even more teed up here in Q1. So we've got a lot of growth happening in the fund. So it's kind of like a ramp up. We're in a ramp up phase. So I was just doing the math. We've funded 17 million into the fund thus far, and then we've got over 45 million committed coming in over the next 6 months. So this fund is growing at a rapid pace. No delinquents so far. We've had 100% performance. Here's of the assets that closed. We've closed on 6. Weighted average LTV at 69%. Loan to cost, those would be the developments, are 71%. Just over 2 years on the maturity length. And here's our gross fund yield right now as it stands. So just under 18% right now. That number we expect to go up with some of these other kind of back ends that we've modeled in. So our track record. So again, we've been going for over 12 years. This fund specifically is targeting kind of a 50-50% split between preferred equity and loans. So then the loans would be broken up between mezzanine and bridge. You'll have basically 25 and 25 of that 50%. And then the other 50%, again, preferred equity. Focus, again, multifamily properties, but then we're also going to do some, as you've seen, do some other asset classes like industrial, some retail here or there. things like that. Focused on diversification and, diversifying geography as well. So you saw those are all over kind of Midwest, the Mid-South, et cetera. Kind of unique advantages. We've got a deep history in this space, but also we're very sophisticated when it comes to private debt. We've been doing this for a long time, built our entire track record on this, and we got a lot of brain power here in the organization. Target investment size, again, this is a unique competitive advantage of this kind of 1 to 5 million. That'll, as the fund grows, that'll likely get up into the kind of $7 million range. And then we've got a ton of experience operating deals. So if we ever had to take an asset over, we're actually set up to be able to operate that asset effectively, which is what the banks don't want to do. So here's kind of the breakout of where we're at today on our real estate holdings and some of our support team that are kind of involved. So CBiz is our auditor. This fund is third-party audited. So we do a GAAP audit every year, which the first one will come out 4/24 here. It usually comes out in May. So we'll publish that publicly to all of our investors and partners. Wilson, our law firm, who's created all of our legal and does all of our legal representation, and then McDowell Rice assists us in deal diligence, so background checks on operators, sponsor lender negotiations, creating those agreements at the asset level. So kind of fund level legal, asset level legal. So that's it. I know that was a lot of information, but I think that covers it for now. So we'll have some time for Q&A. Did I finish in time? I did.
Yes, you are doing great. You are doing great. And if anyone have any questions, you can feel free to unmute yourself. But if you want to have, like a private discussion, if this fund gonna be the right opportunity for you, you can also go to like on the QR code here to schedule a call with me, and I can walk you through. And one of the things, yeah, you can scan the QR code here. Anyone have any questions here?
I have a comment. Mike briefly mentioned debt as it relates to investing with your retirement accounts. So when you invest with your retirement accounts, if you're leveraging other people's money, the portion that's leveraged or that you're borrowing is considered to not be coming from your retirement account. So let's say I borrow $100,000 to invest $200,000 into something, and we make $10,000 of profit. Well, 5,000 of it is derived from other people's money, not my retirement accounts. There's a little bit of taxation in those situations, but that is a very low amount in this situation. But it's just something to be aware of, and it's not a bad thing if you have what we call, I believe we call UBER or UDFI, right? Unrelated debt finance income tax. But it's not a bad thing because you're getting profits based on using other people's money, which is bank money, and you're paying tax only on that amount. So something that we'll likely discuss more in depth as becomes more relevant with like real estate investing in retirement accounts.
Yeah, I'd kind of piggyback on that. So a lot of that relates to the ratio, amount of leverage that's being used in a fund. So for example, if we had, this fund currently has a $3 million line of credit. We've got, if you look at the amount of capital that's in today, 17 million, you can kind of do the math there of how much that leverage ratio would be 17.6% leverage ratio. So that means of the $10,000 in income that was generated, 17% of that came from debt. And so there could be some taxation back into your IRA in that scenario. That line of credit is not going to stay the same, and it's also not necessarily going to be fully deployed all the time. So the ratio is likely to be around kind of in that 10 to 15% range for this year. And so it could be a point where it may not actually exceed. There's a threshold at which the tax is incurred. It could be below that. If it's over that, it'll be nominally over that and create a small implication back into your IRA. But otherwise, as long as the yield is high enough, it's still, far outpacing what you would find otherwise in terms of, keeping it in your traditional, Fidelity or wherever that might be.
And for this one, you also get tax benefit that comes with it too.
That's
I
correct.
believe that is about 15 to 20%. So if you invested, let me give you an example. If you invested 100,000 and on your K1, you're going to receive the negative like 15,000 to like passive loss of 20,000 to offset your earned income if you are a real estate professional. And we can talk to you more about how do you qualify as a real estate professional. But if you don't have the status of a real estate professional and you have other passive income from real estate somewhere else, you can also use this fund to offset your passive income as well. So it's not just the passive income that you're going to get out of this fund, you can also get tax benefit at the same time. So it's almost like, you get like a win-win double too, right? But
Yeah, if you want any detail on how we're doing that, I'll kind of give you, 5 seconds on it. Is, half of our allocation is going to be those preferred equity positions. So preferred equity is technically not a loan, and so we participate. The income that's being generated is technically rental income, and because of the nature of our position, we've negotiated to participate in what's called depreciation. So the depreciation of the underlying asset is what's reducing kind of the taxable basis for the investor. And so by us participating in those, we can pass that benefit through to our investors. It'll be kind of proportionally, like loans don't participate in depreciation, preferred equity can. And so those two things will kind of work in tandem. So it's, if you had an asset, say we were deployed 100% into, preferred equity positions and all the underlying assets were 30% depreciation, we could pass through 30% to the fund. But because half of our allocation is loans, that's getting cut in half in a sense. So that's an oversimplification, but that kind of gives you the rationale behind it.
Yeah, this will be more relevant if you guys really dive deep. There's a lot of things that we'll discuss, and there's a lot of underappreciated opportunities to generate passive income that we're going to explore, like investing passively into things like car washes, which have really good depreciation and profit margins. Investing passively in other people's businesses and real estate syndication, mobile home parks, and all those things that we'll eventually discuss. And when you'll eventually see when you stack this on top of those ideas, they all come together, not only diversification, but tax efficiencies.
Yep.
yeah. Anyone else have any questions that Mike is here, he can answer?
Tyler, I wonder if you have any thoughts being your lending background.
Yeah, I've got a question, I guess, on, lending on the as-is value. Like, take, for example, that one apartment complex you showed. It was underperforming, 30% occupied. What's the loan value? Kind of where do you top out as far as mezzanine and preferred on the as-is in that scenario?
Yeah, so I mean, in a deep value add, those are generally like we only had that one asset. So the lender restructured to the point where we were at a 66% loan to cost, and then they could do because they awarded the property to another operator, they were able to kind of wipe out all their equity, the previous owners, all their equity, and then use that to reduce the basis. So because of that, it ended up reducing the ratio down to 66% loan to cost. And then as soon as they got it up to, I think once they get up to kind of 85% plus occupancy over these next, year to two, they'll be looking for kind of a refinance out and kind of wipe us in the senior out. So that's why it's a 2-year. It's a 2-year with a third option potentially if they need the time. But yeah, we did that on a loan to cost basis on that particular asset because it was deep value add heavy. They were doing full renovations and things like that.
Mm-hmm.
So they can't qualify. This is the senior is a private lender as well. And, obviously they can't qualify to go get agency debt because of their occupancy percentage.
Right. So not a bankable deal yet.
Correct. Not yet, but it will be. I mean, it's a great asset, great market, great location, just terrible execution by the previous owner. And now, a more seasoned operator's already got it back on track.
And you can also use your retirement account to invest into this fund too, correct? Right?
Yeah, that's correct. So it'd have to be a self-directed retirement account, but no problem to do that.
And can like if someone who is not a U.S. resident or citizen, can they invest into this fund as well?
Yeah, I mean, so there's two considerations. So there's the parent fund and there's your fund. So for our purposes, we don't work with anything that's not either a U.S. Citizen, resident, and or entity. So if it's a U.S. based entity, that's kind of how we work around that. But you get to determine that at your fund level. There's some additional, tax withholdings at your fund level that you might have to do if you allow an individual international investor to come in. So typically the way to work around that is they require them to create a nationalized LLC and then kind of invest through the entity. And you'll still have to do a KYC and all that for them. But yeah, that's the best path in our view.
Right. And most people, they either invest using their own individual name, or they can also use their entity name.
Yeah, it doesn't matter.
Yeah. Okay. Thank you. Anyone else have any questions?
Do you want me to pull up those FAQs? Would that be helpful? I kind
Yes.
of closed it out here, but
Yes.
let's ask some questions that you're maybe not thinking of.
Because after this presentation, I am going to send out all the information, the slide deck, and also the recording, so you can rewatch it at your own time. Because sometimes when it's like new technical term, it might be harder to to catch all the information. So I think that's going to be useful, and I also put that all the contact information at the end of the slide too, so you will be able to reach out to us if you have any further questions.
Cool. I think on here we covered most of these questions. I think there's probably two that we maybe didn't. So what kind of tax forms can you expect? So we always produce a K1. Then that K1 would get kind of redistributed through Patro's fund directly into you guys pro rata. So K1 is what you can expect. As far as when distributions start, so they're basically immediate in the sense of whatever quarter you fund in, you'll get an immediate pro rata share of the profit split that would come for that quarter, which gets distributed quarterly and about 10 days in arrears. So like Q1 will get distributed by the 10th of April. We'll process that through to Patra and her team, and then she can pro rata do that out. So call it, 10 to 30 days post quarter close is when those profit splits will come. And then the preferred returns will start accruing after the 90 days. And so then those monthly checks would start coming. So yeah, it's already rocking and roll. It's already making money. So I think those are the only two questions we didn't really answer. But as always, I'll be available if you need anything, but I appreciate you letting me join you guys here today.
Yes, thank you so much for all the information, Mike. And I visit Mike in person. I think it's about, because that a part of my due diligence when I introduce the opportunity to my investor, and the member of the club is I visit their facility, their headquarters. Last time I think I went to Kansas to meet with Mike and Aspen team. And what I did is I would interview their employee. I didn't tell you about it, but I interview your employee to see that how do they like working with the company, and also talking with others, people who work for you, like to see that what is the feedback on that. So I'm pretty transparent. So I just want to that's a part of my due diligence. And I also, before I introduce to everyone, I invest myself. It shows that I have a skin in the game, and when I see the result, that's when I want to share to everyone. And this is a high grade quality investment that usually it does not, if you are a smaller investor like 50,000 or something, it's harder for you to invest into this type of fund. That's why we pull the money together, and we have so we invest into like, that's what Mike talk about, like prefer class B. So that means I put the money together so that you all can have an opportunity to invest into this fund. Yes. All right, and thank you so much everyone for joining. And for our next event, our next workshop, we are going to talk about oil and gas. This is a very popular topic, especially for 2025, since you can get the IDC cards, like tax benefit upfront, and Mike gonna be, his fund also, like his company also have is a sponsor on this video too. And you're gonna learn a lot more about it, and I'm very excited to share with everyone. So it's gonna be on February 12th at noon, and I hope to see you, everyone, back here, because you don't want to miss it. All right, thank you,
Thanks so much.
everyone. Thank you so much for being here. Yeah. Bye. Bye.
Yeah.
Hi.
And that-
Yeah. I know that you are interested to offer to your clients too, and you can chat more.
Yeah, this oil and gas stuff can help anybody out here. It'll reduce anyone's taxes, regardless of your status, as long as you are susceptible to taxes. Oil and gas will reduce your taxes. So it's really neat.
Yes, and I'm ready to do that. But anyway, this just mean the world to me that everybody is here. Seriously, I am building this club is for everybody to connect, and the slogan connect, invest, and prosper. So we wanna, building well together, and it's not just being rich, right? Also like create connection and being a community, a trusted community that we can rely on each other and help each other. So that's the goal.
Good job.
Thank you. Thank you. I see everyone later. Bye. Bye.